this is a good time to talk about market cycles.
Yeah.
Right. And like to talk about how people see market cycles. And when we talk about a bottom and, like we've had this over the career of the show, we've had this kind of like a couple different times that we've hit on like, wait a minute, a real estate market cycle is probably not the right, maybe cycle in the word. Because when you think of market cycle, you think of up and down,
Right.
and circular, right? And the graphic that we show the most is this graphic that shows a cycle in its own right, right? Like shows the trend line of how over time Jacksonville has stayed on this like median trend line of again, not great with numbers, 4.9%.
4.8%.
4.8%, right? Like even though you see the bubble here with the Great Recession, and then you see it come back down, and then you see it come catch back up, and then you see us above it in during the COVID era, and then kind of like dance right back to the line. This was the normalization period. It was kind of like this return to the line where things had flat. And even in this, you see all this up and down, right? So I challenge you to come up with a graphic of like, how do we look at actual home price appreciation in a way that shows this? And you came up with this, which is really, really interesting. Did you see, talk me through this?
Yeah. You know what? I loved our discussion about this because it kind of struck me that when people think of cycles, they think of up, positive, growth, or decline, like you were mentioning.
Yeah.
But in real estate, you don't really see that. You see above average growth or below average growth.
Yeah.
It is very, very unique to see decline. And that's why cycle, even though it is a cycle, it might be a misnomer.
Yeah.
Because in the rest of the investing world, when we talk about cycles, we have periods where we make money and we lose money.
Yeah.
But in real estate, when it comes to home prices, it really doesn't work that way. So this was something that I think will help kind of illustrate this point. This is overall U.S. annual home price appreciation rates going back to that same timeline, 1982. And, when we are looking at home price appreciation levels, it is very, very unique for you to see any type of decline when we're talking about the U.S. overall or your individual market. It just doesn't happen very often. But when we look at it graphically here, you see 39 out of 44 years on record, you've had home price appreciation. Only 5 out of 44 years have you actually seen declines of home prices across the U.S. And so that's 89% of years you're seeing growth. Most assets don't demonstrate that. And that's why, as we relate some of these previous conversations, right? Why does Buffett make a bet like that? Well, he understands that home price cycles are different than other cycles. It's not just about, are you going to have profits or declines? It's, are you going to have higher than normal growth profits, or are you going to have lower than normal growth? Which is something that I wanted to show graphically.
Yeah, I love the graphic, man. So, the illustration is this idea that a real estate cycle isn't up and down. A real estate cycle is like way up or a little bit up, right? And just kind of like continues to happen, which is why this idea of like long-term investment, set it and forget it. This idea of, me betting my retirement in the highest floor, highest return asset class that I would like to have, right? Like as opposed to the roller coaster of other asset classes feels so good to me because I just, if I can just keep stacking chips and betting on like this thing to do what it continues to do, it's going to be year over year a good experience of continuing to rise in home prices. And it can't help but, like notice that it's been in this last year, the most recent time where it is at this kind of like lowest upward point, right? Like lowest growth. And every other time that we've seen it at like really low growth, it ends up coming back into like these like other high things, except for when it was structurally like an issue inside the housing market, right? So like, I love this representation of the real estate cycle as kind of like up, slightly up, right? And it looks almost like a musical thing, like it's like going up, but it's never right. Like music never goes like negative sound. Right.
There you go.
So yeah, it's an interesting graphic representation.
Well, and keep that up there because right before we were on the show, you were saying, wish you could overlay interest rates on this, and I think that's a really great point. So I'll do that and we'll show it some other time here. But I think it illustrates a great point. What was going on with interest rates in the 80s?
They were super high.
They were super high. Yeah. What did U.S. home prices do in the 80s?
They went up.
They went up.
Yeah.
You know, there have been other periods of time where there's really high interest rates.
Yeah.
This high floor that we keep talking about.
Yeah.
Critical need, right? That creates this high floor when there's a supply and demand balance, and there's more demand than supply. That creates this high floor. So it's not all about interest rates, and that's what we've seen in a few years in this negative narrative of, oh, housing is going to crash, or it's the worst thing, or nobody's buying, or whatnot. When you look at the real data, you look at it here, it's still been a very, very high floor, even though we have had higher interest rates for longer. The highest increase in the shortest amount of time and the longest amount that they have stayed for interest rates in recorded history. And we still have a high floor.
And we stay positive.
There you go.
Yeah.
So
yeah.